Here's the problem. Why are African miners more exposed? On paper, they look technical, but in reality, they can shape valuations, distort EBITDA, and derail transactions. And yet, you won't hear this discussed on most of Mining Indaba's panels. Most African mining risk does not sit in the pit. It sits quietly in the notes to the financial statements. There's an IFRS time bomb on African mining balance sheets, and almost nobody is talking about it. Under IFRS, mining companies are required to recognize environmental rehabilitation and mine closure obligations under IAS 37. These are long-term liabilities, sometimes stretching 20 to 30 or even 50 years into the future. On paper, they look technical, but in reality, they can shape valuations, distort EBITDA, and derail transactions. Here's the problem. Rehabilitation provisions are almost always underestimated. Why? Because they rely on assumptions. Assumptions about future environmental standards, closure methodologies, inflation and discount rates, and regulatory environment decades from now. When those assumptions are optimistic, the EBITDA looks healthier than it is, and balance sheets look stronger than they really are. But why are African miners more exposed? You see, African miners are uniquely exposed to this risk, firstly, because of the long-term lives of the mines. See, African mines have vast, rich mineral deposits, and the ongoing technological innovations extends the extraction of those minerals. So many African assets are designed to last for decades. Secondly, there's regulatory uncertainty. Environmental standards are tightening across the continent, but enforcement timelines are unpredictable. Think about the Carbon Tax Act of 2019, which had Phase 1 come into effect in June 2022. Or the National Environmental Management Laws Amendment Act 2 of 2022, or the Climate Change Act of 2024. All these laws have a huge impact on the mining industry, with further regulatory developments ongoing. Third is the capital markets pressure that the industry faces. Global investors are increasingly forensic about ESG liabilities, even when they're buried deep in the notes to the financial statements. Investors understand the exact impact that these disclosures have on their returns on investments, and they take them into account and price accordingly. So why does this IAS provision matter for CFOs and fund managers? For CFOs, the requirements to recognize environmental rehabilitation and mine closure obligations under the IAS 37 isn't about accounting footnotes. It's a capital allocation risk because it can distort the financial position and performance of the company. Because in essence, the IAS 37 requirement transforms a potential future environmental cost into a present quantifiable financial liability. And this is significant because it's forcing companies to plan for and potentially lock away funds for these obligations. This directly impacts how a company deploys its capital, introducing a risk that resources may be misdirected due to measurement uncertainties and simply made unavailable for growth-oriented investments. For fund managers, the rehabilitation and closure provision isn't just a theoretical issue. It directly impacts the net asset value, exit assumptions, and downside protections. And yet, you won't hear this discussed on most of Mining Indaba's panels. So, like this video by clicking on the button below so YouTube can show it to people who will value the information just like you do. And subscribe to the channel so you don't miss out on any deep dives ahead of the 2026 mining Indaba. You see, the next cycle of African mining won't just be defined by ore grades or commodity prices. It will be defined by who properly prices long-term liabilities and who doesn't. At AfriTenacity, we believe the real risks and opportunities in African mining starts below the headlines, and we're just getting started.